I'm Steve from Resolute Private Wealth, and welcome to our August monthly update. Over the past couple of weeks, share markets have fallen from their recent highs as a result of the ongoing tit-for-tat US-China trade war. Recently, Trump has increased further tariffs on Chinese goods, and he has also ordered US companies to seek alternative trading arrangements other than dealing with China. This is in response to the Chinese placing a small level of tariffs on the US goods. The purpose of a tariff is to increase the cost of that good. For example, if the US imports a product from China which costs $100 and a 10% tariff is placed on that good, it would then sell for $110. Now, being a higher price that's less competitive, you'd assume that there'd be less people buying that product, and in return that would hurt the Chinese and their exporters. And secondly, the benefit of the tariff for the US is that it would make local goods more competitive from a price point of view and protect that local industry. Now, over the course of the month, the Chinese have devalued their currency. The Chinese don't have a floating rate currency like Australia. The government actually control the currency within certain bands, and that's pegged to the US dollar. But effectively they set and control the currency, and over the last month they've devalued their currency, which has the effect of negating the tariffs placed on their goods imported into the US, which is quite interesting, and from my point of view I think it's quite clever, but those sorts of actions are causing quite a bit of volatility, and we've seen that over the past 3 or 4 weeks. With the share market bumping around quite a bit over the past few weeks, it's not uncommon for the topic of the share market and volatility to come up at social gatherings. So I thought I'd take this opportunity to put up this chart at the moment, which shows the range of returns over a number of asset classes ranging from cash to property to Australian shares. And the chart shows from 2004 to 2018 the range of returns for each of those asset classes and which asset classes have performed best from rank 1 to 6. And as you can see, it's incredibly difficult to predict what is going to be the next best performing asset class. During 2018, a daily average of 460 billion in equity trading took place around the world on a daily basis. The combined effect of all this buying and selling is that all available information from economic data to investor preferences and so on is quickly incorporated into market prices. So trying to time the market based on an article from this morning's newspaper or segment from the financial TV segment is incredibly difficult, and it's highly likely that that information is already reflected in today's prices by the time that you or I or an investor can react to it. Further complicating matters for investors to have a shot at successfully timing the market, they must make a call to buy or sell stocks correctly, not just once, but twice. Now, in regards to market timing, let's suppose you have a 70% chance of being able to time the market in respect to both buying and selling. Now, 70%, they're pretty good odds. But remember, you need to be able to both buy and sell, so you need to get both transactions right. Assuming that both of those actions are independent of one another, 70% by 70% equals a 49% chance that you'll get both of those decisions right, which is less than 50-50 statistically, which goes to show that market timing is incredibly difficult. And for that reason, in times of volatility, it's really recommended that you stay the course and hold true to your investment strategy. Hope this helps, and we'll speak again next month.